Well, from a macro perspective, of course, we finally had the 2010 4.6 trillion budget passed by the National Assembly last week, Thursday. After unpacking it a bit, I mean, some of the assumptions are looking to be a bit optimistic, don't you think? I mean, what are your overall impressions of this budget?
Well, you know, on the one side, one might be tempted to interpret it saying, well, you know, the economy's been going through a bit of a slump, they need to boost, you know, fiscal spending, and that's pretty much what they've done here. But I guess one has to be a bit cautious, and it does raise eyebrows because, you know, the level of savings going into the excess crude account, the extent of the expenditure, I mean, these are somewhat disappointing. I mean, we're talking about a 30% increase in spending over last year, right? Those are big numbers. And at the same time, if you put that in the context of the central bank, which is working hard to try, or you know, starting to warn about inflationary pressures in the economy, you know, you have to start at some stage saying, but you know, this is going to force the central bank into raising interest rates at some stage because this is massive stimulus coming into the economy. You know, so that, you know, and it's very likely to be inflationary as we go through the year. And one could question, was this really necessary when the economy in the fourth quarter last year had already picked up to growth of something like 8–9% in the fourth quarter. So the economic side was already improving. Then on the savings side, last year they used an oil price. Remember, the oil price rule is anything in excess of the oil price that they set in the budget goes into the excess crude account as a saving. Now, the excess crude account, remember, had dropped down to $4 billion, its lowest in a pretty long history. And given these new assumptions that they're putting into the budget of around about 2.1 million barrels per day and $60 per barrel price, it means that the effective saving is likely to be zero.
Exactly. I mean, they've raised that price target or that benchmark price by $10 from what President Yaradua had initially outlined on that budget. And, you know, some are getting concerned because while we do have oil prices at this stage hovering between $69 and $80 a barrel since the beginning of the year, there are concerns that we are going to see some decline in oil demand moving forward on a global scale as well.
Yeah, it is worrying. I mean, that 2.1 million production, for example, now that will include condensate, which is not in the OPEC quota of approximately 1.7.
Yeah.
But condensate, I think, typically is around about 15% in addition to whatever the crude production is. So you're still talking about, you know, something like 2 million barrels per day, or very close to 2 million barrels per day, that needs to be produced just simply to meet the target. Now that is in excess of the quota, that is in excess of what they've done on average over the last 6 months. So, there's some very, very optimistic assumptions built in. And now if you suddenly get hit by some type of a global economic shock, interest rates start rising in China or whatever the case is, you know, then you could find that the oil price drops and it drops to below, and they simply don't have money to dip into the savings account. I mean, $4 billion isn't going to last them very long.
Bringing us to the issue of the fact that, you know, where we've got this deficit increasing to what, more than 5% of GDP, it's sitting at around about 1.5 trillion. And yes, as you say, it's a reflection of the necessary, possibly, fiscal stimulus, you know, due to the current macroeconomic conditions, but it will in turn reflect this increasing growth in government debt as well. And the question there is, moving forward, you know, with the risks that are still out there, not only in Nigeria, but on a global scale as well, is this manageable growth on that end?
Well, Nigeria, in some respects, similar to South Africa, very low debt levels to start off with. In fact, even lower debt levels than South Africa. So from a balance sheet point of view, they're looking pretty healthy. They've got very strong growth in the local fund management industry in terms of assets under management. So there's huge demand, I mean, which is, you know, helping, which should support the equity market in the long run. But equally, it helps support financing the government deficit because simply there's so much money which needs to be put to work. So, you know, would it necessarily be a problem? I don't think so. You know, most of it will be locally financed. I don't think that there'll be huge foreign demand for assets in Nigeria. When they come to market with a $500 million bond that they're talking about, that might be, you know, be picked up, obviously, that would be picked up by international investors, and it probably would go okay at this stage. But I think primarily it's going to be financed in the local market by local investors.
Well, that the broad macro picture as it stands over in the country right now. Let's get into the latest of what's moving the market, specifically on the equity side of things. And for that discussion, we're crossing over to Lagos to chat to Muyiwa Oni at Stanbic IBTC Bank. Muyiwa, thanks so much for joining us this morning. Well, we were talking about activity in the oil space. Total Nigeria announcing yesterday that pre-tax profit fell back back 5% to 6.2 billion naira in 2009. Overall market impressions of those numbers released?
Oh, hello, Alicia. Thanks for having me. The market didn't really respond positively to the result. The performance was rather flat. And I think one major reason why was because the company had already released their dividend payout for the year, and the total final dividend was slightly over 8 naira, which was about a dividend yield of 5.5%. And I think because that information had been out in the market for over a month now, that was why investors didn't really respond to it. But I think overall, Total is still a company that appears to be moving positively, because for us, really, we didn't expect the company to do that well in the fourth quarter, considering all the challenges the sector had. And I think the major reason why it was able to perform that positively was because, in our view anyways, we believe the storage capacity of the company was quite large, and that's why, even though importation of refined petrol reduced significantly at the time, the company was still able to increase or maintain turnover because of the large storage capacity.
Well, looking at Stanbic IBTC's report on those numbers, you're maintaining your buy recommendation, target price of 444.7 naira. That implies an expected return of 232% over the current market price. So you're clearly positive about this company moving forward. What are some of the factors you see boosting company performance moving forward?
Yeah, like I said, I think a major factor might be storage capacity. Even though we haven't been able to discuss with management yet on these current results and to see what plans they have in expanding capacity. But I believe storage capacity will be a very large driver, a major driver in terms of growing market share and even growing turnover as well. And I think another factor that might play a major significant role would be the PIB, would be the deregulation of the sector as well. If that is done, we'd expect that margins would increase, even though market forces would have a major part to play in that. But as a whole, I think that also would increase performance for the company.
Well, along with Total, we had Zenith Bank releasing results as well. The real surprise when it came to those numbers, the unexpected bonus of 144. Many saying that it should lead to demand moving forward, as bonuses have historically been a major driver for stock appreciation. What's your outlook with regards to Zenith?
We're rather surprised with that information as well, because the company had already done an interim dividend of interim bonus, of 1 for 2. That was in May last year, and so we were quite surprised to see these results as well. Declaring a dividend, a bonus of 1 for 4, and also the dividend of 45 kobo wasn't quite surprising, because we had a forecast of 44 kobo. So for us, that wasn't surprising. But in terms of the company's results, we didn't expect, we actually had a forecast of about 25 billion for PAT, while 20 billion naira was released. But overall, we still have a very positive view for the company going forward. If you also consider the fact that the bank won't really have to make any major provisions compared to what was done in September last year. And if you also consider the fact that most banks, including Zenith Bank, has also tightened and improved their risk management framework. So we expect to see such large non-performing loans going forward. So in my view, really, we'd expect to see better performance for Zenith Bank.
So your recommendation then, one would assume, a buy at current valuations?
Yes, it's still a buy at current valuation, but we still want to discuss in full detail with the company to be able to revalue and see if we'll still maintain our buy recommendation. But the buy recommendation is currently under review, so depending on what our valuations give us at the end of the day, we might review that. But I really don't expect that to happen.